Good evening and welcome everybody to the Federal Reserve rundown for tomorrow, the 19th of March. Let's get stuck straight into it. We're going to start off and talk a little bit about today, what to expect in the session. We're going to go through some of the expectations for the meeting. We'll talk a lot about pricing and what the market's thinking is into this meeting. We'll then move on to the dot plots, talk a little bit about dot plots. Of course, go through the January minutes and have a look what was key there, as well as what Fed Powell said recently in March. We'll look at some key indicators, key economic data, the statement, etc., and then some of the key tradable opportunities for tomorrow's meeting. Now, before we get going, of course, for those of you that are new to Tradelo, do make sure you go and subscribe to our YouTube channel. Every day I will do a daily market rundown there. We go through futures markets, some of the key tradable opportunities on the day, and some of the things for you to be aware of. Do make sure you like and comment and subscribe, because it does, of course, help the channel. And then for those of you that are futures traders, Tradelo 2.0, which is our web application, will be launching soon. It is a risk management application with data analytics, with a community, with a whole bunch of charts, a whole bunch of features, a full stack application, all geared towards futures traders. Of course, it includes education, trading journals, and everything you will need as a futures trader. So stay tuned. Of course, do make sure you subscribe to Tradelo, and we will update you once that launch takes place later on this year. Right, let's get stuck into it, and let's start off with how we frame tomorrow's meeting. So before every session, for these preparation sessions, what we're trying to do is frame a summary of, what is it that the market wants to take away or understand from the meeting. Because if you can do it in this way, if you can form a construct, ultimately you'll know what is market moving and what is not. Now, I think the key construct for tomorrow ultimately is this question of, is inflation or growth your priority, Fed? Okay, now if you go back to the start of last year, 2024, the Fed shifted its priority. It shifted its priority squarely to effectively the labor market, where it said, look, we will accept higher inflation, we'll accept we're not getting back to target anytime soon, because we want to safeguard the labor market. And we saw that it was in full view in August, when we got the slowdown in non-farm payrolls. We of course had the Fed cutting by 50 basis points already at the September meeting. Okay, the point is they prioritized the labor market. Now the key question is, are they still prioritizing the labor market / the growth in the economy? Or do they perhaps shift back towards prioritizing inflation, given the risks around tariffs? That is ultimately the question that investors are going to be wondering. Has there been a shift in the priorities in tomorrow's meeting? If not, well, all things being equal, everything continues as is. If there is a shift, that is significant, because it's going to create a number of ripple effects. If they shift that focus back onto inflation, gold is going to drop very fast. The dollar, of course, is going to bid very quickly. And the equities, ultimately, they are going to take another beating to the downside. And that's why we form this construct, because we need to know where are those big fundamental shifts as we head into tomorrow's meeting. Now, in terms of the Fed dot plots, that's going to get a bit of focus tomorrow, because we do get an update from the December dot plot, and a lot has happened since December. Now, if you cast your minds back, December, the Fed was talking about a sort of a two cuts this year, 2 cuts next year, perhaps one more in 2027, but ultimately another 4 cuts to get to that sort of supposed neutral rate. And this is why the Fed, and in particular Powell, says we are still restrictive. Okay, he still believes they are sufficiently restrictive, meaningfully restrictive, and should things slow down, should inflation come back to target quicker, or should we see a deterioration in the labor market, they believe they've got enough room to cut enough to ultimately stabilize things. Okay, and that's simply because they still think there's around 4, maybe 5 cuts before they get to neutral. Okay, hence they think things are still restricted. Now, in terms of the chart you're looking at, the reason we frame it as, is it inflation or growth, is because we can see since the start of this year, there's been a little bit of a fright ultimately in the markets, a little bit of a growth scare, similar to what we got in July. We can see 2-year yields paired off from 440 all the way down to 385. Last year it was a bit more dramatic when we went from 440 all the way down to 360, but we've had a little bit of a growth scare. So that's what investors want to know. Fed Powell, do you care about it or not? Let's get stuck into it. Now, the first place to ultimately start off with is, what is inflation doing? Well, look, inflation seems to be heading back on track. Okay, that's if we're looking at, of course, at the lagging data. So the print has come out at 2.6 now, which is the lowest print ultimately in this cycle. And we can see that average is pretty much flat, stuck around that 2.7. Now, the Fed told us they expect 2.5 this year, so they're not expecting inflation to get back to target, but they have told us if suddenly that starts to come down a bit quicker, we'll get on with it and we'll cut a little bit quicker. Okay, the reality is the big major problem the Fed has now is Donald Trump is very intent on putting tariffs in place, and the Fed does not actually understand, and they're not willing to commit yet to ultimately what the implications are going to be for tariffs. And that is ultimately something that Chairman Powell is going to get pegged down on a lot tomorrow. He's going to get asked a lot of questions around tariffs. Are they inflationary? Are you willing to look through it? Are they transitory? When do you think you'll know? Does it impact growth? He's going to get asked every question under the sun about tariffs tomorrow. Okay, and it's important you listen out, because how he answers it ultimately is going to dictate how the markets will move and shift in terms of his interpretation of whether or not the tariffs will prove to be inflationary longer run or not. Now, like I said, you can see there with regards to the Fed dot plot, they're expecting inflation of 2.5% this year, and they're only expecting to get back to target effectively next year. Now, the question mark is, with the dot plot projections, do they still think they get there next year? Okay, the reality is, if they're going to revise this 2026 dot up meaningfully, say perhaps to 2.4%, guess what? They're probably going to be accompanying it with some very, very hawkish rhetoric, which is, look, ultimately we may see rates higher for longer, and we may even need to hike again. Okay, now that is a very, very unlikely scenario. Okay, but the reality is, at some point this year, they may actually be forced to raise that 2026 dot. And most likely that is going to be accompanied by some hawkish rhetoric. Okay, is that a case for tomorrow? Perhaps not, but something, of course, to be aware of. Okay, now in terms of some of the key economic data, we can see JOLTS continues that trend down. Is it a problem? No, of course not. We know 7 million is the long-term average, so we're just returning to where we were pre-COVID levels. If we move on and talk about the unemployment rate, we can see that the Fed thinks unemployment is going to be around 4.3% this year, and currently we're hovering around that 4% mark on a 3-month average. So again, things are not problematic at all. Now, I appreciate the data points I am showing you are lagging. Okay, don't forget, this is all kind of in the rear view mirror, and ultimately consumer discretionary, which is slowing down quite aggressively, that is very much a leading indicator. But the reality is, with what data we have right now, we cannot be too concerned about the state of affairs. Okay, we are seeing a bit of a slowdown, but it's not yet a problem in terms of where the data is relative to everything else. Okay. If we then look at non-farms, of course, the average, the 6-month average, is sitting around 190,000, and that is not an unhealthy situation at all. So I appreciate we've seen a lot of Twitterati over the last couple of days and weeks talking about recessions and the end of the world. The reality is there's nothing of the sort in the economic data currently. Okay, don't forget, Chairman Powell has often referenced 100,000 jobs as the point or the number of jobs we need to see to keep the labor market effectively from deteriorating, to effectively keep unemployment rate from ticking higher. Okay, and then of course the new data point that the Fed, and particularly Fed's Williams, is now referring to is the Michigan data with a 5-year inflation rates. And so ultimately we see him specifically referencing this, and this is something that could get a bit of attention tomorrow, could get questioned quite a bit, not just because of what we've seen in the last couple of prints, but also because we seem to now be beating pretty much every single forecast. Okay, if we go back to January, we were expecting a 3% print, we got a 3.3% print. Okay, if we go to the next print in February, we were expecting 3.2, it came out 3.3. We're now sitting up at 3.9, and if we look at it, there's just the sudden acceleration that's happening in inflation expectations. Now, I appreciate these surveys are skewed by political behaviors and all that blah 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 blah, but the reality is, at the end of the day, it doesn't matter what your political affiliation is. If you're worried that inflation is going to be 5% higher, you're going to buy stuff today rather than tomorrow. Okay, so the point is, fine, there may be some skew in terms of, you know, what Democrats and Republicans are saying, but the point is that investors right now think that inflation expectations are unanchored. Okay, if you think inflation is going to run at 4% 5 years from now, that's an unanchoring of inflation expectations. Okay, now, does the Fed give a shit about this tomorrow? Well, they should do. Do they reference it? Do they do something about it? Perhaps they do. The point is, we need to be aware of it. We need to be aware of these surveys. Williams has referenced it. It's coming out hot every single print. And ultimately, that's why gold is flying up to record highs. Does the Fed do something about it or not? If they do something about it, if they reprioritize inflation because of these inflation expectations that are rising quite significantly, well then yes, we're going to get a hawkish outcome tomorrow. We're going to see a nosebleed for equities, a nosebleed for gold, and a very nice rally in the dollar. But is that the consensus case? Perhaps not. Okay, we'll talk a little bit about why in a moment. Now, if we look at the rates and ultimately what the rates markets have done, we look at the start of the year, absolutely nothing was going on in the rates. These are just different parts of the curve, by the way. So these are just looking at different Fed fund futures. Ultimately, you can pay attention to the yellow one. I think that's a good proxy. That's effectively the market's expectation of rates out to the middle of next year. And what we can see is that they did absolutely squat diddly do. Late or mid-Feb, we obviously had that little bit of a concern around the economic slowdown. They priced in an additional 50 basis points of cuts. Okay, so we saw quite an aggressive repricing of rates, and ultimately that's now started to pare back with coming off around 20 basis points over the course of the last 4 or 5 sessions. Okay, the point is there was a little bit of concern around this growth slowdown. Ultimately, that's now starting to pare back, and the markets are looking through ultimately some of that growth scare that started, of course, in late Feb. Okay, now turn our attention to Powell. He's the governor. What does he say? What does he think? And he told us what he thought effectively 11 days ago. So I think this is important because what's changed over the last 11 days? Absolutely nothing. Okay, I appreciate, sometimes people or traders particularly want something out of every Fed meeting, but in reality, most Fed meetings are a damn squib. And ultimately, the fact that Powell told us his thoughts just 11 days ago suggests that it could well be another damn squib. We may not actually get too much from this meeting, okay, but we do prepare for it. In other words, what is Powell's stance? Well, he told us, look, the Fed is very well positioned to wait for greater clarity. In other words, our policy is so well positioned that we can afford to wait. Okay, in other words, they're not going to jump and make big decisions without big data in front of them. Moreover, they've told us some near-term survey and market measure of inflation expectations have moved up. Okay, that's that Michigan data. So what do you mean, Powell? What does that mean? What are the implications? Are you going to do something about it? Are you willing to consider rate hikes? Okay, those are the kind of questions he's going to get asked about given what's going on in these near-term surveys. In terms of recent indicators, point to possible moderation in consumer spending. Okay, we've started to see the consumer slow. Of course, this little bit of weakening in the equity markets will also further dent consumer spending because a lot of people's consumption is tied to their 401k. Okay, so does it matter? Chairman Powell, do you take into account the 10% correction in S&P? No, we don't. Yes, we do. Okay, listen carefully how he answers that. If he shrugs it off, fine. Maybe the equities offer a little bit on that. Is it significant? Of course not. Okay, Fed policy not on a preset course, can maintain policy restraint for longer if inflation progress stalls, or ease if labor market unexpectedly weakens, or if inflation falls more than expected. Okay, and this has been his tagline for some time now, which is we have got rates at meaningfully restrictive levels. If the labor market slows, we will react very, very quickly. If inflation comes in down a little bit quicker, we'll act very, very quickly. In other words, he's a leaning dove. He's definitely anything other than a leaning dove. He very much wants to cut. That is his primary angle right now. What changes that? Well, does he show concern around these surveys on inflation expectations? Okay, if he does and he starts to reprioritize inflation, that is ultimately going to be a key theme for the rest of the year. Okay, and that's what you have to pay attention to. It's this reprioritization of inflation. They dropped it in January last year. They could re-implement it now given what's happened in the inflation break-evens. Okay, the cost of the Fed being cautious is low. In other words, we can wait a couple of months and it's not going to cost us anything. Okay, and I think that's important because effectively we could get the exact same outcome tomorrow, which is we don't need to do anything right now. Policy's in a good place, we've got time, and time won't cost us anything. Okay. He also told us it's simply not what is happening with tariffs, but with growth and other changes. And this is in reference to ultimately, what are tariffs going to be doing? And what he's trying to say is that fine, we first need to learn about what Trump wants to do on tariffs. Then we need to understand, of course, the implications of those on the economy, on the labor market, on inflation, and ultimately they are not going to know the outcome of that yet because we don't even know what tariffs are coming into play. All we know is there's a bit of uncertainty, and we know that there are going to be some tariffs imposed, but we don't know what products, what percentage, which countries. We know nothing. Okay, so it's not like the Fed's going to act with no information. Right now, in terms of summary of Powell, you can see there's no cost to be patient. A lot of uncertainty still around tariffs. Inflation expectations are rising. Okay, it's the first time he's referenced that. So does he become a little bit more adamant on it? And then finally, moderation in consumer spending. Okay, two key themes that he's going to get pegged down and asked a lot on tomorrow. Inflation expectations, the moderation in consumer spending, and then, of course, the tariffs and the implications. Now, Feds Williams backed him up. I think this is interesting. If you look at Feds Williams, he came out on the 3rd of March just before Powell, and he told us details of the tariffs are key to understand. Okay, there it is right there, which is they've got to understand these tariffs in full before they're going to make any kind of understanding as to the medium-term expectations on their policy. Okay, the Fed does not make short-term decisions, so they are not going to be acting tomorrow with no information at hand. He ultimately said we will see some impact on inflation from tariffs. Now that's interesting because he's the first one to kind of talk about this idea that it is going to be inflationary. We're not yet sure if it's going to be transitory or not, and he'll be asked about this quite a lot tomorrow. Is it transitory? Are you going to look through it? Do you care? Do you not care? So again, does he have enough information or does he not? Okay, listen carefully how that gets answered. He then also told us that watches inflation expectations very closely. In particular, he mentioned the Michigan statement. Okay, so of course, Michigan data came out hotter again. We know that Fed's Williams referenced it. So again, this is why it is a key theme for tomorrow and something that's very important to pay close attention to. Now, in terms of course, the Fed Whisperer, that is Nick Timmer's from the Wall Street Journal, he does write very well. I appreciate I call him the Fed Whisperer, but it's more because he does summarize the Fed meetings very nicely. And I've taken out the key parts for you from the Wall Street Journal. There you have it. You can take a snapshot of it. You can also, of course, go read the article. But I think the way to summarize this is ultimately that a couple of months ago, everything was really looking good for Chairman Powell. Okay, it was looking perfect soft landing. He had everything going for him. And then suddenly, the uncertainty around the tariffs started to kick in. Okay, and then the market created a narrative of a growth slowdown. That created a little bit of a correction in the equity markets. That created a little bit more uncertainty. And ultimately now it's the it's not that the soft landing is being questioned, it's just perhaps a scenario where growth expectations are coming down a little bit, and at the same time, inflation expectations are going up. And that's very, very difficult to combat, because how do you combat higher inflation and lower growth? Okay, you have to pick one. You have to prioritize one of them. Do you prioritize inflation or the growth? Hence, the theme of this meeting is Chairman Powell, are you prioritizing growth, the economy, labor market, or are you prioritizing inflation? Okay. Of course, we know the Fed's mandate is both. It's full employment and inflation. And so, again, we do just need to listen very carefully because, like I said, if they do reprioritize inflation, it will be taken as hawkish. Gold will get smacked. Dollar will get bid. Equities will get smacked. Okay. Now, in terms of further on in the article, he talks a little bit about falling in immigration, and of course, ultimately some of the cuts to federal spending being implications for the labor market. And again, that's creating this idea of stagnation in growth. And then, of course, the tariffs. What is it that the tariffs are ultimately going to mean for the economy, and what is the choice that Fed officials have to choose between? Okay, and this is this line here, which is, are you going to cushion the economy, the demand side of the economy, or ultimately are you going to prevent inflation from going higher? And that is the million-dollar question. Okay, does he answer it tomorrow or not? He might not answer it, but this is a question that has to be answered in the next couple of weeks. Okay, it will get answered in some shape or form, and when it gets answered, you need to know how to react to it because it will be significant in terms of the rates markets, in terms of flows in the markets in general. Okay. Let's now turn our attention and talk a little bit about the statement. That is the previous statement. You can go through this in your own time. There was no real change in the statement, and I don't expect there to be any kind of change in the statement. Perhaps some minor word changes, but I don't think there's going to be any change in the statement. I think the opportunity scope will be the initial focus will of course be on the dot plot, but then it's very much about the Q&A. Okay, I don't think there's anything meaningful to pay attention to in the dot plot except for, of course, inflation for this year's dot as well as next year. If they revise that higher, what that does suggest is perhaps the Fed is not going to be in a position to cut as much, and more importantly, that the neutral rate is quite a lot higher than we expect. Okay. Now, in terms of some of the market pricing, as you can see, absolutely no cut price for tomorrow, no chance of that happening. And if we look towards the next meeting, May, there's a 1 in 5 chance of a cut. So it looks the way the market's pricing this, you can see these little stars here. That's effectively the meetings where we have got updated projections from Fed members. And so the market thinks the first cut comes June, and perhaps the second cut comes either at the September or the December meeting. Okay, so that's now the current market thinking. Like I said earlier, the Fed's dot projection as of December said 2 cuts this year. The market thinks roughly 2 and a little bit. Call it 2 cuts. Okay, the market's very much in line with where the Fed's thinking is right now. And like I said, in terms of total cuts to get to neutral, the total cuts to get to end of 2026, we've got around 110 basis points of cuts. Okay, so the market is very much in line with what the Fed thinks. Okay, so there's no real significant opportunity in the rates markets, except for, of course, if suddenly Chairman Powell does reprioritize inflation, at which point we'll get a lot of those cuts coming out of the market. And of course, like I said, there'll be some implications for that. Now, in terms of what does change the policy path, well, like I said, inflation expectations de-anchoring. Okay, are they de-anchoring? Perhaps not. We're seeing those surveys tick up. They are a concern. They've been raised. Do they raise it as a concern? Do they actually put something in the statement to suggest it's a concern? Does Powell drop a hint it's a concern? Well, if he does, then we know what to do. The other one is, of course, if growth stalls. Okay, we are seeing consumer discretionary slowing. We are seeing the consumer come under some pressure. That does have implications, of course, for demand and the economy. So if that growth is stalling, don't be surprised if they reprioritize the labor market and growth and they stick with that stance. The Fed will be called into action sooner to cut rates as soon as, of course, the May meeting. Okay, things can turn very quickly. This is not a case of, you've heard the Fed and all central banks talking about risks are to both sides. Okay, right now, the US economy could stall and they could be cutting at the next meeting. Effectively, the economy might not stall. Inflation might continue to ramp up and they might be hiking later on this year. Okay, all of these possibilities could be true. So right now, we just need to remain nimble. In terms of the dots, I'm not going to spend too much time on this, and hence why I'm not focusing too much on the actual dots, is because to move the dot is going to be some tall order. Okay, remember, these Fed officials are not going to want to be making big adjustments to the dot projection without information on exactly what the tariffs are. So as we can see, the consensus is right there. It's very firmly for 2 cuts or more this year. Effectively, that is the consensus, around 2 cuts. To get 1 cut, you would need 5 members to shift the dot higher. Like I said, that's a tall order. And to get, of course, 3 cuts, you're going to need 4 members to shift lower. Okay, so it's a tall order to get 1 or 3 cuts this year, and I do not think you're going to get that. Hence, the dot plot is not really the focus. I think the inflation dots you can pay attention to, perhaps the growth one if you're bored, but ultimately, like I said, the key play is going to come in the question and answer, where they get to ask him some key questions. Okay, now let's get to some key charts, rate cut expectations. Just to show you this chart, because again, I think sometimes we get hyped up as traders, we get a little bit ahead of ourselves. This is effectively what rates look like at the end of 2026, sorry, not 2025. And what you can see, these little vertical lines are just the last 4 Fed meetings. Okay, what you can see is effectively, as we moved into that October meeting, don't forget, the Fed started cutting in September. That was around this point, and all of a sudden the market went, oopsie, we didn't need all those cuts. They priced out a lot of the cuts that were already priced in, and ever since that's happened, you can see the market is stuck around this 100 basis points of cuts between now and the end of next year. Okay, so we're stuck in this range of, effectively 4 cuts, for next year. The Fed will like to see that. Effectively, the Fed and the market are completely aligned with the rate cuts. And just importantly, I know with this recent price action, there's been some concern around a slowdown. Well, the reality is we got that. You can see in Feb, we can see the market started pricing in a few more rate cuts. However, over the last 4 or 5 sessions, it started to move back down now, back towards effectively where we have been for the course of the last 4 months. Okay, so just pay attention to that. And then in terms of the 2-10s curve, I think this is an interesting one to watch. I think this has been a fantastic signaling. Don't forget, the 2-cents curve is notoriously well known for determining, end of cycle type sort of price action. And ultimately, if we go back to July last year, that's when we got that growth slowdown. That's when the curve disinverted. We moved from negative 44 basis points all the way up to 24 basis points positive. The Fed, of course, began the cutting of 50 basis points right around there. We can see we've got a little bit of flattening out of that. Okay, why? Well, because of course, that's growth, pro-inflation. That settled things down a little bit. We then got the Trump landslide where everyone went, woohoo, this is great for the economy. This is going to light up the back end yields. We're going to reignite the situation in terms of growth and inflation. We got a nice bear steepener there, which was really positive ultimately for the market. That's why we had a very nice rally into year end and of course a start to this year. And then, of course, we got a little bit of flattening again, a bull flattener, and that ultimately has maintained itself since we got this little bit of a slowdown. However, I think the general direction, if we were to smooth this out, is very much for more steepening. Now, the type of steepening we get is going to matter here because should we ultimately get some bear steepening. Let's talk about that first. That's the scenario where, of course, the bond markets sell off, higher yields. Now, we know right now there is a lot of concern around yields, and so should we get that bear steepener where the back end is effectively driving down the page, that is going to be a very, very big problem for the stock market, because the stock market right now can't handle higher rates given we are in a corrective territory. If we were to see, of course, a bull steepener, the only way you're going to get that is by the front end driving up the page, and the only reason the front end is going to drive up the page is because the market thinks we need more rate cuts to shore up the slowing economy. So right now, the most important thing to understand is, should we steepen today, tomorrow, the next day, the day after, the week after, the month after? The reality is steepeners are not good for the market right now. Okay, whether you get a bull steepener, bear steepener, they're both going to be negative for the equity market. Ultimately, you just got to pick your poison. Now, typically how this should work is you should start off with a little bit of a bear steepener where the back end drives down, and ultimately that bear steepener, when yields get to a certain point where it's just too much for the economy to handle, what happens is the market says, well, we need to start pricing in a few more cuts, and the Fed's going to have to be coming into action a little bit sooner than expected. And that then creates the bull steepener, and steepener leads to steepener, and the curve goes super steep, and that's then the end of the cycle. Okay, now all of this is hypothetical, it's all storytelling, it's all fun and games. It doesn't work out as quickly as that. If you go look back at history, these sort of steepener cycles can take 18 months, 24 months, 36 months, because it all depends on, of course, the deterioration or not of the economy. Okay, but pay attention to it. A steepener is not good for the US economy and the US stock market. I do suspect we get it at some point later this year. If we then go to the VIX, I think it's an interesting one to watch. This is going to be the highest VIX we've had for a Fed meeting in some time now. High VIX for Fed meetings doesn't mean you're going to get an opportunity. It just means that what we could get is a scenario where Chairman Powell says absolutely nothing and the market moves a lot on it. What do I mean? Well, look, there is this idea that the Fed ultimately always has Wall Street's back, and there is some degree of truth in that. So should Chairman Powell play his typical dovish card where, you know, he showcases some concern around the recent slowdown in the US economy, and they will not hesitate should it continue, anything along those lines, effectively you're going to get this narrative of the Fed put is back in play. In other words, the Fed will not tolerate more slowdown in the US economy, aka will not allow the US equity market to go down more than the 10% correction. Okay, we've seen this a number of times. I think I've seen this twice already in Powell's tenure as Fed chair over the last 6 years. So just keep that in mind. Okay, it is a very high VIX environment that we're going to this Fed meeting. The Fed does not like volatility. Their job is to squash volatility. So don't be surprised if we come out of tomorrow and you see me tweet that Chairman Powell did it again, the put is in play, and ultimately that should restore some positive sentiment to the markets. Now, I spoke about the dollar in today's daily market rundown. I think it's one to closely watch. Okay, the dollar ultimately has been smacked since the tariff wars ignited. The idea is that Trump wants a weaker dollar, and I think there is some truth in that. The concerns around a slowing US economy is calling into question whether or not the Fed needs to perhaps cut a little bit quicker. But like I showed you earlier, the rates markets are not pricing in more rate cuts. Okay, and so that's why I think the dollar's getting a little bit ahead of itself. If you see the rates markets at the bottom here, they initially priced in there's more rate cuts. We started to pull back already. What has the dollar done? Well, it's not pulled back already. Okay, I think this dollar is very vulnerable over the course of the next couple of sessions. I think you can safely buy this dollar. If you are going to do it, be cautious doing it against the euro. I think that's one currency. I do think euro goes down a little bit in the near term, but I think you're going to get a better bang for buck. Perhaps trading some of the risk-off currencies like Swiss franc, as well as I think pound is a good one to be selling against the dollar in the next couple of sessions. Okay, very much a tactical buy. It's very much one of those where I think risk-reward now, you've got a little bit of sort of symmetrical risk-reward here, and I do expect the dollar to bounce in the near term. Okay, with that in mind, like I said, gold is an interesting one. I've mentioned this in today's market rundown, which is inflation expectations from investors have collapsed. They've sold off quite aggressively. We're trading 270 start of the year all the way down to 235. They haven't bounced. The Michigan survey of inflation expectations just seems to be going higher and higher and higher. So one of these is going to prove to be right, and one of them is going to prove to be wrong. Gold seems to be going off of the Michigan. Gold seems to be looking as a very good hedge against this rising inflation concern. And very, very importantly, as of today, if we look at this blue line versus this green line, that's the widest spread between the 200-day moving average in gold that I can see on my charts going back a long, long, long way. In other words, gold by many metrics is overbought. Okay, now that doesn't mean it can't stay overbought. Okay, typically overbought conditions neutralize themselves in two ways. One, via price coming back, or two, via time lapsing and price not moving. Okay, that's the two ways markets neutralize themselves. So what I think is important to stress here is not that gold is a sell. You don't want to just go and sell it like a blind old fool. But what you do want to do is be very aware that longs are very, very vulnerable at these prices. Okay. Now, what changes the dynamic? Well, if Chairman Powell comes tomorrow and reprioritizes inflation, you got to watch out, because that gold will be dropping $200-300 pretty quickly. Okay, we'll trade back down to that 200 moving average very fast, and I think a very good correction will come in gold. But it's only if he reprioritizes inflation. Okay, don't forget, this entire rally going all the way back to January started there. What happened in January 24? The Fed Powell told us we are focusing on the labor market and we'll accept higher inflation into the medium term. Okay, so again, it's not a likely outcome for tomorrow, but should it happen, don't forget, gold is a very overbought market. In that scenario, it's a fantastic risk-reward play. Now, in terms of the S&P 500, we know what the chart looks like. We've got that correction in play. We've had that tactical bounce now. I know it doesn't look like much, but that was a good 240 handle bounce in the equity markets. They seem to now have found a little bit of a short-term top. They're starting to roll over a little bit. But again, it just means we're stuck inside this range. Okay, I don't think we're going to exit out of this range anytime soon. Like I said, you're going to need a lot more hard economic data to showcase that we do have a real slowdown before things either continue to the downside. Okay. In terms of the upside, however, don't forget, given we are inside this range, what that does typically mean is that whatever Powell says tomorrow, we can play a little bit of ping pong. Okay, we can very much go back up to yesterday's highs. We can very much go down to last week's lows, and we can just play around in this range and accept this range. Okay. Now, very important to the upside, we do have that gap sitting around that 57.60. I suspect that at some point that does get traded out in the near term. What ultimately would be keeping me interested to play for that to the upside? Well, I think very much a Powell that comes out tomorrow that puts that put back in place. Okay, should he tell us he is concerned, he will not hesitate to act. We're still very restrictive, and they could cut, and every meeting's live. And should we see further deterioration in consumer spending, they will not hesitate to act. Anything along those lines will be taken as dovish, and the equity markets will simply like that. Okay, let's then summarize before we open up for some Q&A. Of course, you can all post your questions so long in the chat box. I will answer as many of them as possible. Ultimately, the summary for tomorrow is that there's no real likely statement adjustment. I don't think you're going to get much of a play in the statement adjustment. I think you can definitely have a look at some of the inflation sort of adjustments. Do they adjust those inflation expectations for this year and next year? I think this year is perhaps not as important as next year. Why? Well, because the Fed makes decisions on the long term, not on the near term. Okay, so if they keep next year's dot at that 2.1%, okay, that's pretty much a damn squib outcome. Okay, in terms of the Q&A, look very closely as to how he answers inflation. Okay, sorry, the tariffs. Does Chairman Powell think they're going to be transitory or not? Okay, if he says yes, we think they'll be transitory, ultimately they will maintain this dovish stance, and the markets will absolutely love that. Okay. However, we're concerned about it. We're concerned about inflation expectations. Any kind of concern around inflation expectations, that is going to cause a little bit of a hawkish lean. And then, like I said, is growth the new priority? So are you going to prioritize the economy and the labor market still? Or perhaps are we going to start prioritizing inflation again? I think that is the key takeaway for tomorrow, and that's of course where you need to be focusing your attention. Okay, with that in mind, we've got just a few updates for the members. Do just post some of your questions in the Discord channel. Of course, if you have any questions about tomorrow's meeting, just post them there, and obviously myself or one of the other mentors will answer that. And then, of course, you've got the Tradelo risk application. Make sure you're managing the risk. It will be, of course, a volatile session. Make sure you know where that opportunity scope is and how many lots you want to use. And then finally, yeah, like I said, just follow the Discord post. I will be posting after I've exited some of the trades that I've taken on the day. Okay, otherwise, good luck then for that session, and I will now turn my attention to some of the questions. Okay, first questions come across. How does the inflation prioritization affect Dixie? Thanks for the outlook. Yeah, very simple. If they're going to reprioritize inflation, what they're telling us is that effectively rates will remain higher not necessarily indefinitely, but indefinitely until they start to see inflation break back down. Now, if they're going to reprioritize inflation, what they're actually telling us, in essence, is that the current policy stance is not sufficiently restrictive. Okay, so by definition, if you tell me that you're going to reprioritize inflation because you think inflation expectations are de-anchoring, what you have to then do is you actually have to go and hike rates. Okay, so the reason why it's so significant is because not only will the market pull out the June cut, it'll effectively need to pull out the cut for June and perhaps even later on the year. And you might even get some people pricing in a hike. Okay, I don't think that's necessarily the play. I think the first thing in terms of sequences of what happens is market participants will first get rid of the rate cut in June. Okay, so if there's a 25 basis point rate cut in June, that needs to come out of the market first. The next part, of course, then the market says, well, look, how many more rate cuts can they do if ultimately they do need a more restrictive policy stance. Okay, so the neutral rate will be higher, and then eventually, over the course of the next couple of days and weeks and perhaps months, we may find out that they are actually done cutting for the cycle. Okay, but for tomorrow, to answer your question, what happens is the first thing they do is they ultimately pull out the June cut. And like I said, dollar's very oversold in the near term. So what that means is dollar gets a very, very nice bid up the page. In terms of gold, it's pretty obvious. It's a very overbought market. It's very much an inflation hedge. And so a lot of those inflation hedges will get pulled out. And yeah, I mean, in terms of expectations, you can see dollar up 1.5–2% on the day. You can see gold down 1.5–2% on the day. And both of them should have follow through for a couple of days and weeks. Okay. Next question. Will Jerome be addressing tariffs in this meeting? Yes, of course he will. He'll get asked a lot about it. Okay, he's going to get asked a lot of questions about the tariffs. And I suspect the answer to that question is we don't know what tariffs are coming into play. They'll be modeling things. Okay, they're not idiots. They're sitting there trying to model if he puts 25% on Mexico and on Canada on the 2nd of April, what does it mean? If he puts them on car imports, what does it mean? So they will be trying to model it, but you can understand how difficult a job it is because 1 month Trump says, yes, it'll be on this and that, and then he changes his mind 2 days later. So the Fed pretty much has as much information about the tariffs as what we do. And so it's nigh on impossible for them to really understand the implications. What the Fed does understand is uncertainty. Okay, I think they definitely do understand the uncertainty. They can see that, and they'll probably showcase that in the downgrading of their growth projections. And so if they're downgrading their growth projections, they are telling us the one side of the equation is that tariffs will have implications for demand, which is we'll have a slower demand, therefore slower growth. The other side of the coin, of course, is do they have enough confidence to tell us they'll be inflationary or not? Okay, I don't think they have that information yet. But again, this is what we have to listen out for. If Jerome Powell comes out and says yes, they'll be inflationary, and we need to do something about it, well, there you have your answer. Okay, but yeah, hopefully that answers your question. Okay. So if there are any other questions, I'll be happy to answer them for another couple of minutes, and then we can, of course, go from there. Okay, just another question coming on about, of course, looking at yields and the higher yields that we've seen over the last couple of sessions in the 10-year. Yeah, look, I think that's very interesting. Of course, Trump and Besant have been telling us how happy they are to see yields coming down, and their stance on tariffs is really working magic. Well, the reality is, if you go look at long bonds over the last four or five sessions, those yields are just gradually ticking higher. Okay, so I think that's very, very interesting. Keep a close eye on yields tomorrow. Okay, the bond market, everyone was convinced of the slowdown, and now we're starting to see bonds offer again. And so everyone is long bonds because of that slowdown and that potential recessionary fear. So don't be surprised to see those bonds stage a hard offer over the course of the next couple of sessions. Okay, the price action there is very, very weak again, and that's not what the US administration wants to be seeing. Okay, do you expect anything new around quantitative tightening? Yes, very good question. Again, there's been some talk that perhaps the Fed could come in and shore up a little bit of confidence in the markets given the recent turmoil in the stock market, and perhaps end prematurely the balance sheet runoff. Again, this is definitely a possibility. Okay, I think if they did it, it would be very political. It would be very much favoring Wall Street. It would be done simply to shore up Wall Street. So the play there is very simple. Okay, it doesn't matter whether what your beliefs are. If they were to end the balance sheet tomorrow, what they're in essence sending is a signal to Wall Street that, look, we've got your back. Okay, and so that will very much play into a positive sentiment scenario. What does that mean for, of course, things like gold and the dollar? Well, I think initially gold should stage a bit on that. Okay, at the end of the day, if you're going to stop the balance sheet runoff, you are effectively providing a bit more stimulus at a time when, of course, inflation is not yet conquered, when there are inflation expectations that are a concern. So yeah, definitely one to watch out for. Not a high probability, not a high likely outcome. We of course have heard from Fed officials, including Williams, to say that no, everything is going exactly as expected with the balance sheet and no change. Okay, so it's not a likely outcome for tomorrow. Of course, it's a possibility, so we've got to keep an eye out for that. Thanks, good question. And then of course, finally, any specific month estimation when the web version of Tradelo would be available? Yes, the short answer is I would love it to have been in December. Unfortunately, we had a little bit of a setback with our developers. So we have pushed back our schedule. We hopefully will have something in April. I think we are going to release a version 1 in April that will be a baseline risk management application with a trade log, as well as, of course, a sim to live challenge, which you can use to determine if you should be trading with live money or not. So that will be the baseline version 1, and then we will release the version 2 perhaps 2 months after that. That'll include, all the premium trading education, as well as, of course, all your trade analytics, your trade leaderboards, your community, all those other things. So yeah, hopefully that answers the question. There will be a version 1 coming in April month. So yeah, like I said, if you have signed up for Tradelo on the website, of course, we will update you on that. And with that in mind, we actually do have a new website launching in April as well. So that'll be nice and fun to reveal to all of you. You can see the new website and see some of the things we've been up to. Okay. All right. Thank you very much, everyone, for joining. I think let's leave it at that. Apologies for being a little bit late today. Of course, we had the Trump-Putin call to contend with, just to understand the implications of that. So hopefully you all managed to survive that and weren't too bored through that and didn't do anything crazy through that. Okay. That's a wrap for today then. Please do make sure you like and subscribe. It helps the channel. And of course, tell all your friends, share it with the traders. It really does mean a lot to us. Otherwise, good luck for the FOMC tomorrow and stay safe.